Hey everyone, it's Daniel Snyder from Seeking Alpha. Welcome to probably the most important webinar we have ever done in the past few years that we've been doing this. Today, I am joined by the all-stars, Stephen Cress, here from Seeking Alpha, VP of Quantitative Strategies, as well as Francesca Friday, who also works with Steve on the Quant team. And we are going to dive through everything macro, what's going on with the markets, as well as what is the investment approach going forward that can help you probably sleep a little bit more soundly at night. But before we dive in, let me go ahead and get our quick legal disclaimer out of the way. We are not advising you personally concerning the nature, potential value, or suitability of any particular security. You alone are solely responsible for determining whether any investment, security, or strategy, or any product or service is appropriate or suitable for you based on your investment objectives and personal and financial situation. This presentation is for information purposes only. Content is presented as of the date published or indicated and may be superseded by future events. It represents my opinions, Francesca's opinions, and Steven's opinions, which may not reflect the views of Seeking Alpha as a whole. Past performance is no guarantee of future results, and Seeking Alpha is not a licensed security dealer, broker, or U.S. investment advisor or investment bank. Now, with that out of the way, Steve, there's a lot of uncertainty out there. You've been calling this for a while, but before we dive in, for the people that may be joining us for the first time, why don't you give them a little quick background about yourself?
Daniel, thank you so much for organizing this today. Highly important in light of all the moves that are happening, a lot of fear and anxiety out there, and we're hoping we could address that today. And I have been in the markets for quite a long time, almost 35 years in the financial markets. So I do have a fair amount of experience through highs and lows. My background has really been mostly in brokerage firms and asset management. I've been a portfolio manager, headed up a prop trading desk at Morgan Stanley and Quant Strategies for 13 years. That was the bulk of my career. I also had a hedge fund that I founded in Quant Strategies, and I started a fintech company that was acquired by Seeking Alpha about 6 years ago, which, for lack of a better description, was one of the first versions of AI for a robo-advisor and picking stocks. So that's a little bit about my career. For those who are familiar with me, I've been writing for Seeking Alpha for a long time, and I run the quant models and alpha picks for Seeking Alpha. And I'm joined by our quant writer, Francesca Friday, who joined us from the Financial Times. Francesca, tell us a little bit about yourself as well.
Hey, thanks for having me, Daniel and Steve. So I joined the Seeking Alpha team late last year from a place called Merger Market, where I was a senior private equity reporter. So that's where a lot of my background is, covering the private markets. I also wrote the FT's award-winning newsletter Due Diligence, and that covers topics from M&A to private equity to hedge funds. So I'm really excited to be a part of the team and diving a little bit more into the public markets with Quant.
Thank you so much. And I'd say with Daniel Snyder, who always has his finger on the pulse of the markets, this is a great trio to be having this discussion today. So I've had a mantra for quite a while, many markets, many presentations like this: keep calm and carry on. For those who know myself and Daniel, we've had quite a few webinars like this when the markets have been rolling off quite considerably. And this consistently has been our mantra, and it is not going to change today. And we actually started this mantra most recently in January with a couple articles that I had written and guidance that I had given to the market. First off, though, I want to really start with what our quant vision is. And that is to eliminate emotional investing and uncover top stocks using data-driven tactics, which is especially important today because there's a lot of emotion out there and there's a lot of fear. And what we really want people to do is just stay true to a disciplined investment process. Don't really pay attention to the talking heads. There's a lot going on Bloomberg, on CNBC, on CNN. Everybody's talking about the fall off in the financial markets, the tariffs, a lot of uncertainty, a lot of unknown impacts. And really the best thing that you can do is just stay focused and trying to find good investments based on good financials and good fundamentals. And that's going to be a good portion of our presentation today. So our quant vision, turbulent times and market volatility, turn your weakness into opportunity. And this is a message that I've had time and again during periods like this. And I think individuals who have heeded that have done quite well by taking market uncertainty and volatility and using it to their favor. It can be your best friend. So what we're going to cover today is why quant. We're going to do a recap on the markets, and we'll obviously be covering what's going on with our approach to investing in markets. First, a little bit about quant and what we do. We basically at Seeking Alpha, our quant strategy is a GARP-oriented strategy. That is growth at a reasonable price. So we're looking for stocks, in essence, that have strong fundamentals based on growth, value, profitability, positive analyst EPS revisions, and momentum. Those are our core factors that we look at. And because of the ability of our incredible computer models and the powerful computer processing that we possess, we can take those factors and basically score every investable stock every single day. So literally, we provide a directional recommendation on every single stock. And when we do it, we're looking at the metrics for our companies, and we're going through cash flow, income statements, balance sheets, and hundreds of financial metrics. And we compare the metrics for companies to other companies in the sector. So this gives us the ability to filter out the weak companies from the strong companies. So part of what we're doing today in our approach, in this balanced approach to investing during this turbulent period, is to look for stocks that possess really good fundamentals, but of course, heeding what's going on in the markets and trying to help eliminate some of the losses that could occur, is to encourage people to invest in stocks that have good fundamentals with dividends as well. So the barbell approach is continue to look for companies that have excellent fundamentals, irregardless of the dividend, identify those companies, but also identify companies that do pay dividends that have good fundamentals, and use that as your balanced barbell approach. So we have a pretty good track record at Seeking Alpha with our quant performance. And if you could bear with me, I'd sort of just really want to go through that. We have a back test that goes back to 2010, which shows what our investments would have been like had you invested in all the quant strong buys. And what's interesting about this chart is the back test actually runs from 2010 to 2019. After 2019, we had the system up and running and there are simulated trades. But because we know what factors that we look at, we can identify those stocks historically that possess those factors. And what we do is we back test, trying to identify the factors that have the greatest amount of predictability. So over time, we have come up with weights. So when we're looking at the factors such as value, growth, profitability, momentum, and the many underlying metrics for those overall factors, it's not equally weighted. Some factors have greater weights than others. Hence, using that system, we've been able to achieve some outstanding results over a long period of time. So if you went back to the initial back test, you would see your return would be 2,900% compared to the S&P that has a return of 458% for the same period. But if you look at the recent history, where we've been up and running, starting in 2020, where the trades have been simulated, the performance is still just as good. You can see the quant strong buys were up 347% versus the S&P on the far right up 135%. Now, the purpose of showing this is we actually don't have an investable product. There's not an ETF or a mutual fund of our strong buys. The point of showing this is to identify how the concept works well, which is that GARP approach, and using the certain weights that we have on factors, it has presented us with some fantastic opportunities that we continue to repeat over time. So as a premium member or an Alpha Picks member, you have the ability to obtain these stocks that are recommended and have these directional recommendations based on the underlying factors. So that's how we've achieved such good performance over a long time.
All right,
we'll
Steve,
also, yeah.
I want to jump in real quick. I want you to have your victory lap, right? So
Okay.
to get back to what we're talking about today, obviously we can talk about the quant system all day, but you've been calling for this market uncertainty for months now. It feels like you've been writing the articles, you've been doing webinars with myself. I mean, we just published the top 10 stocks for April video earlier this week, where even you were talking about the barbell approach. So if you go to the next slide, we can showcase the work that you've been putting out there. So I just want to encourage everybody, if you're not already, follow Steve and Cress on Seeking Alpha. You've been getting these articles. You know that this environment was set up to be uncertain and volatile like it is today.
And Francesca was kind enough to pull this slide together to showcase that, Daniel. So trying to be as humble as possible, and having assessed the markets for a long time, it was, from my perspective, I was able to tell back in early January that there were problems with the market. And one of the things that I say about our quant model is it's often like a Richter scale. When we notice that there are problems with the stocks that we have strong buys, And typically we're identifying the best companies in the best industries and the best sectors. They have the strongest growth rates, they have the best valuation frameworks, they have great profitability. But what tends to happen during these periods before the market turns, our quant strong buys often become very volatile and start selling off. And what we're able to see is that there's an early rotation where there's a flight of capital, and that flight of capital could be to defensive sectors like consumer staples or utilities or cash or gold. And what's interesting is when this initially happens, and much like a Richter scale will go off, it could take a little time before that earthquake happens. The overall market actually continued to go up, but it was going up as investors were rotating into these different sectors. So you can see, I wrote this article back on January 10th, the best defensive stocks to hedge against market uncertainty. And then on January 27th, feeling bearish. And then, of course, on February 25th, brace for turbulence. And that was just after the market had sort of peaked, I believe, the S&P 500 at that point. But we saw those signs. So now, when I looked at the market, it was obvious to see what some of the key signs were that was causing that disturbance. And there was increasing talk of tariffs. And there was also a degradation that was starting to occur in earnings, especially with the Magnificent Seven stocks. And I pointed out in many of these articles with the Mag 7 stocks that their year-over-year growth had actually been higher than their forward growth rates. And that was across the board for all 7 stocks. So obviously, if you have the largest 7 market cap stocks and their growth rates are starting to slow compared to their year-over-year growth rates, and then you had the position coming out of the administration with the drumbeat that was getting louder and louder on tariffs, it was obvious to see why there was volatility with many of our quant strong buys early on. And really, it doesn't matter how good the company's earnings results are or their top line results are. When markets get defensive, it's just a giant sucking sound, and it rotates into defensive sectors, as I mentioned, healthcare, utilities, REITs, consumer staples, cash, gold, and people sell stocks where they made money. So it doesn't matter if the fundamentals are good or not. They're trying to raise capital, they're trying to raise cash, and they're trying to allocate into sectors that will offer them some protection, irregardless of how good the companies are. And that's exactly what we started to experience in early January and why I was writing about it. So I also wanted to highlight, I put this slide up in February 23rd. Will there be a 10% correction? So I highlighted the long-term outlook then. Predicting the exact likelihood of a 10% stock market correction in 2025 is challenging due to many unpredictable factors. However, history does provide some context. And one of the key bullet points that we had here was between 2002 and 2021, the S&P 500 experienced declines of 10% or more in 10 out of 20 years, indicating that such corrections occur approximately every 2 years. So, the history had shown we were at a point where the bull market had run and it was entering its 3rd year. And previously, when you went more than 2 years with markets that had returns in excess of 20%, we found that between 2.25 years and 3.25 years, the market on average would return at that point after 4.8%. Hence that correction that came. That might sound a little bit complex, but basically the way the math works is that every couple of years the market has a crash, okay? And that crash likely will be a minimum of 10%, and in some cases 20%. And we were really hitting on the cusp of it. So the timing was perfect for this to actually occur. I did write a couple articles today that I wanted to highlight, which I think are very timely. One of the articles is Tariff-Resistant Investments, 3 Stocks for Trade Turbulence. And the article that I wrote was Trump Bump Hits a Slump, 8 Stocks for a Downturn. So if you have the chance and you're on Seeking Alpha, you could look up my name and find these articles. And please do follow me so you can see some of the articles that I write in the future as well. So this brings us to our current period of 2025 and what the market normalization is going to be just after this incredible rotation that we've been seeing. So just keeping in mind, in 2023 and 2024, the markets then were dominated by the Mag 7. And you may recall in 2023, the Mag 7 stocks on average were up 111%. And it was still a difficult environment because in 2023, we had rising rates, we had increasing inflation. So really, investors had a bit of a rotation to what then was a safe haven, were the stocks that had cash, that were really profitable, that were the Mag 7 stocks. So based on the fears of rising rates and inflation, but in combination with the AI revolution, you had the Mag 7 do incredibly well during 2023 and 2024 as well. However, as we're coming into 2025, there's a lot of volatility. We have tariffs, we have economic uncertainty, we've had a lot of executive orders coming out of the White House, we've had changes in the regulatory environment. So there's been incredible gyrations, and there's also been the beginning of some massive layoffs in the federal government as well. And now, sort of at a corporate level, many of the executives and CFOs are facing a lot of uncertainty with the tariffs. So there's uncertainty what they're going to be doing with their CapEx budgets going forward. Up until a couple of days ago, the Mag 7 stocks were down on average about 6.7%. That has quickly changed. So that's actually a little bit old. I think right now the Mag 7 stocks are down on average about 20% at this point. You can see just a couple of days ago, the S&P was down 5.54%. At this point today, the S&P is down over 11%. So just in the few days that we've been writing these slides, the market has come down tremendously. So what is like the normalization that we're going to most likely see for 2025? So as I mentioned, the S&P has pulled back roughly 10% or 11% from its 52-week high, which was at this point about 45 days ago. The NASDAQ, I believe, is down almost 20% from its high. So ignoring the slide here, and that was about 110 days ago. So just in the last 5 days, we've had these huge moves in the market. And the concerns are around tariffs, inflation, corporate earnings deterioration, and the looming and increasing fears that a recession may occur. And all these have contributed to the pullback that we see. And on the back of these fears, investors obviously have been taking profits. They've been selling their stocks that are winning. And when I say those stocks that have been winning, you could look at the Mag 7 stocks. You could look at a lot of the stocks that we've been recommending over the last year. They have been hit particularly hard in the last couple of weeks, despite the incredible results that they've had in terms of their earnings announcements. So what has done well? We have seen a shift to consumer staples, as I mentioned, utilities, REITs, healthcare, cash, and gold. And that's sort of how the market plays out during a period of fear, which is exactly what we're experiencing right now. So this next slide says blind faith has a short shelf life. And it's just sort of an example that really just in November and December, Wall Street was rejoicing. Trump won the election. They did announce the aggressive tariff plans, but really at the time, people thought that would be a tool for negotiation. And that has clearly turned from a tool of negotiation into a reality. So at this point, we have fears of stagflation, which are starting to mount. We have other countries that will be matching tariff increase. So we have basically a tariff war that's occurring. We're probably starting to see a slowdown in economic growth. We'll probably see rising unemployment, and we'll probably see inflation numbers coming in much higher than expected as we go into the next several months. And this is all being factored into the market today, yesterday, the day before. People have been positioning for this. So really, with the market being down 5% today, it's almost like an orderly decline in the market because a lot of this news has been out there for the last couple of weeks with the events that happened yesterday, with the announcements of tariffs, with the bad news being laid out. The market is sort of just absorbing that right now. So a lot of these moves have already taken place. And this, I think, is a good chart on the right-hand side, which just shows you how much consumer confidence has slipped. And this is before yesterday. And you can see the incredible change in delta from consumer confidence in November of 24 to March 2025, where it dropped to 92.9 from 111. And this is prior to what happened yesterday. So we'll probably continue to see consumer confidence slip in the weeks and months ahead. And we'll probably be seeing it sort of on the corporate level as well. And many of the reasons, why this is occurring, I've already mentioned. But what I want to show here is the VIX. And we had a period back, I believe it was August last year. Daniel, is that correct?
Yeah,
Where
August
you
5th.
put up a similar slide and the VIX had surged over 60. And the only time previously to that in recent like history was during the great financial crisis. We're seeing today the VIX is not up as much as it was during that one gyration or during the financial crisis. And I think the market can take heart to that this is a bit of an orderly sell-off that we're seeing. And we're really seeing, with the movement in interest rates today, investors are going into bonds. So bonds are going up a bit, yields are going down. People continue to go into cash. People continue to go into consumer staples even today as we're speaking, based on the fears of unemployment rising, economic uncertainty, and what's going to happen with inflation with all these tariffs. But the good news is we can see that the VIX has not surged to some of those previous levels, which tells you it's a bit of an orderly sell-off. Daniel, I want you to tell us about this chart.
Yeah, Steve, thank you. So I think this is, like I said, this is probably the most important webinar we've ever done, right? I want to take a second and just remind people what the VIX actually is, what it actually does, because it always comes up in conversation. People lose hindsight of the VIX is a calculation of the option prices 30 days in the future, calculating the strikes and the implied vol that the market is seeking. If people are hedged, you don't get these massive shoots that just pop up like crazy in the VIX, right? So keep that in mind. Also, you have to remember the historical average of the VIX is around that 20 level. So when you take that 20 level and start building out standard deviations of what is a normal distribution, your first standard deviation takes you up to about 28 to 30, depending on how you calculate it. What we're showing here is, I don't know if you all remember the collapse of Silicon Valley Bank. When that happened, we barely got over the 28 level before the market pulled back. That was a moment in time where people were wondering if they need to take cash out of their bank accounts. They were anticipating a failure, and yet the VIX never got above 30, really. Then if you go to the next slide, as you were talking about on August 5th, we saw a 5 standard deviation event on a Monday morning because people didn't know what was going on in the currency market, right? No nuke got shot in the air. The markets were still open that day. They didn't close. Like, for the VIX to pop, right, there is still a possibility. I'm not going to say there's not a possibility here, but for the VIX to pop, there has to be something unseen that hasn't been hedged by everyone on Wall Street and customers out around the world, right? People knew about the tariffs, so what Steve was saying. They knew the tariff announcement was coming. This is why, as Steve mentioned, it feels like a controlled sell-off in the market, which is why we only got to about that negative 5% value today. But I just wanted to highlight that. So
Yeah, and I think these were great slides, and I did throw in a little plug there for our quant system. During the collapse of Silicon Valley Bank, our quant rating system was one of the very, very few systems on Wall Street that had a sell on Silicon Valley Bank. I don't think there was one other firm out of the big tier banks or the second tier brokerage firms. No one was really calling for a sell. And our quant system had a sell on a number of the banks that actually had to merge or were taken over during that period. So hats off to the quant system during that period. So I'm going to take us to what we're seeing in terms of a 30-day recap, bring us right into this current period. As you can see, it continues with this rotation. So looking on the far right, over the last 4 weeks, the 1 month period, we're seeing a move into energy. I think that is sold off today, so that's probably beginning to disappear. I took this from early this morning. Energy has moved down. Energy stocks have moved down as well. But you can see the sectors that perform well were utility and consumer staples, and to a certain extent, basic materials. And basic materials are interesting because commodities actually fluctuate quite a bit every year. So the fact that we have these tariffs that are coming in, at all different levels, anywhere from 10%, to maybe 30%, people have to bake in a lot of volatility with basic materials and commodity prices. So that's why you're not going to see that sell off. And of course, people are moving into gold and silver as well. So that will impact basic materials. But of course, if you look at the bottom on the right-hand side, just in the 4-week period, the sectors that have sold off sharply were the ones that are the best performing sectors for the last 2 years running: technology, consumer discretionary, consumer communication services. Those sectors that were the best performing ones have sold off. So this is sort of a recap. And again, we have a bit of an orderly sell off today because this has occurred over the last 4 weeks, this rotation. So the tariffs were not really a huge surprise, hence like the VIX not getting to those previous levels. Part of the warning that I mentioned that we saw early on in January was, the discussion of tariffs growing and that sound getting louder and louder. I put together this graph because the market and economists and the economy do not like tariffs. So you can see on this graph over here and the performance of the S&P 500 the year that tariffs were launched. So the big year was when Herbert Hoover was president. In 1930, he launched the Smoot-Hawley tariffs, were actually the tariffs that are most similar to the ones that we are seeing today, which were global tariffs. And in 1930, the market fell 28.5%. And that was on the back of the market coming off sharply in 1929. And of course, that was really driven by, an incredible amount of margin that was made available to the market, margin calls, and then central banks sort of tightening into that period when the market was collapsing. So between 1929 and then having the Smoot-Hawley tariffs in 1930, it was a really harsh period for the market over a 2.5-year period there. But the tariffs had such a negative impact on the markets that there wasn't another president until Richard Nixon that launched tariffs, and that was during the Nixon shock. And those were pretty light. So in the year he launched it, the market was pretty much unchanged. However, I will say a recession did follow that. And the recession sort of started in 1969, sort of resurfaced through 1973, abated, and then continued again into 1975. So it was a really bad economic period, 1969 through 1975. Again, tariffs not having a good impact on the market, but George Bush, to a limited extent, had steel tariffs that he announced in 2002, and the market reacted very negatively to that. It was down 23%. Of course, there were other issues during each of these periods. You had the oil shock in 1970, and of course, you had the start of the Depression in 1929, and then when George Bush was president, obviously we had the Iraq War occur and the horrible New York crisis with the World Trade Center that occurred too. So that was a pretty horrific period. So it's not all tariff related. In 2018, Donald Trump had China and steel tariffs, so very limited compared to the amount of tariffs announced yesterday, but the market fell about 6.2%. And then, of course, you had the pandemic. So I'm not sure what it is about tariffs, but they seem to come along where periods in time where there are other events that are not very timely. But on average, during these tariffs, during the first year that they were launched, the S&P fell about 14.5%. So you're already seeing the NASDAQ probably about off 20%, and the S&P 500 close to that now. Here's a little bit of history as well. We took 14 major crises that have occurred since 1980, and we have measured the decline. So what I'm looking at here is the question that I'm getting is how long could this potentially last? So since 1980, the markets have entered a correction every 3.2 years. 173 days is the median pullback period. So if we were to base it now, if I was getting that question now, how much longer would this last? I would say at a data-driven approach, we could say if we were to hit that median period of 173 days, we're already 45 days into sort of the pullback. That means that we would hit that 173-day median August 9th of 2025. So during this summer, we'll get to that point where the median is occurred. And, it's likely the pullback may have even occurred, before that point. So you could see throughout these 14 periods, on average, the market fell about 25%. The average amount of days was 253%. The median return was negative 20%, with the median number of days being 173. Now, worst case scenario, I put at the bottom, and I didn't include it because it's an outlier. But of course, that was a stock market crash and the Smoot-Hawley tariffs from 1929 to 1932, where the market was off 86%. So as an outlier, I did not include that in those numbers, but it's really not uncommon. We have this every 3.2 years, the market will pull back. Sometimes it's 10%, sometimes it's 15, sometimes it's 20%. There are events that occur. This is a structural event. Tariffs are big. So obviously it's, the impact could be felt more than just today. The market's going to continue to look to see what happens with inflation numbers what are the chances that the Fed will have to take interest rates back up? So that's what the market is going to be looking at, as well as companies pulling back on CapEx spending. So there's a lot that the market has to still digest. In terms of what interest rate traders are betting on, they're looking for May. Most interest rate traders, about 72% of them, think that interest rates won't move at all and that the Federal Reserve will hold steady. About 27% of the interest rate traders are looking for a 25 basis point cut. So clearly the majority of traders are looking for no change by the Fed and that rates will stay the same. If we take this out to July, that's a little bit different. We have about 52% of interest rate traders looking for a 50 basis point cut by the time we get to that July period, which is interesting because I said that medium date it would be August 9th. So very interesting if that does occur, that we have a 50 basis point cut. That could be a good foundation for the markets to start to lift from that point. Something I really want to highlight that's incredibly important is not, when we have these panic periods, not to sell. And there's a lot of data that shows you why you don't want to sell during these periods. And, people obviously have sold off today. The market's come off a lot. As I said to Daniel before, the horse is already out of the barn. There's no need to shut the gate at this point. So what I want to highlight here is from JP Morgan Wealth Management. They have highlighted that 7 of the S&P 10's best days occurred within 15 days of the 10 worst. So that means, again, like your best trading days occur right after the worst days. And if you invested in the S&P 500 for over 20 years, you would have achieved annualized returns of 10.5%. However, if you missed out on just the 10 best days over that period, the return would be cut to 6.2%. That's why it's really important to stay in the market during these periods and not be scared out of it. And something else that I really want to point out during really big panic periods. So take a look at 2022, which was not that long ago. On average, okay, most people have already forgotten this. On average, the Mag 7 stocks declined by approximately 46% in 2022, significantly underperforming the S&P 500, which fell about 19.4% that year. So you probably recall that was the pandemic year. However, just 1 year later, in 2023, on average, the Magnificent Seven stocks surged by approximately 111%. So 2022 down 46%. 1 year later, you're up 111%. Let's take the worst case period. If we go back to the Great Depression, 1929, from September 1929 to July 1932, I bet that was a pretty long period. The S&P declined by 89%. That is a whopping number, okay? Point is, don't panic, okay? If you invested in the S&P 500 from July 1st, 1932, and held it for just 1 year to July 1st, 1933, just 1 year later, the S&P 500 was up 159%. So there you had a decline of 89% from 29 to 32. And then from July of 32 to July of 33, just a year later, the market was up 159%. So this is the entire reason why you do not want to panic during these periods. Because if you do, you sell at the absolute worst time.
Hey, Steve, can I jump in real quick? I also just want to do a quick little plug because we're talking about the Mag 7 here. The top 10 stocks for April, you actually selected a Mag 7 stock for that for the first time, I feel like ever. So that goes back to this market pullback is presenting opportunities. But go back to the fundamentals, right? Go back to the earnings, listen to management, see what's coming ahead. But I just wanted to put that out there, that there was one Mag 7 stock that you did pick recently.
Yeah, and that's, that had to do because the valuation framework has changed during this market pullback. So finally, our GARP system is growth at a reasonable price. Most of the Mag 7 have multiples that are in the stratosphere. So our system just doesn't invest in stocks like that. And we have a great track record, as you saw. We've beaten the Magnificent Seven stocks, over time. We've beaten the market over time. We have an incredible track record using our GARP strategy. But we are going to avoid stocks like the Mag 7 that have multiples that are like 35, 40, 50, 70 times, 100 times. They just won't be factored into our model. But yeah, I believe, Amazon had come down and that got whopped today too. So the valuation is probably going to be more attractive on many of these Mag 7 stocks. So we might actually begin to see more of these become buys or strong buys in our model. So looking again at, not panicking, not selling, if we look at the last couple pullbacks that we had. So recent history, I'm just going back to 2010 here. We've had 5 times that the market has pulled back 15%. So what I wanted to show people, especially since a lot of the stocks that we've been recommending recently have been hit really hard. So I'm not going to deny that, okay? As I said, it doesn't matter that most of these companies have been beating the results when they announced. They've been hit really hard, and that's because of the rotation that's occurred. People are moving into cash and utilities and consumer staples, and they're selling stocks, and they're selling stocks where they made money. But the point being here, since 2010, if you had invested when the market pulled back 15%, okay, if you took just the top 10 quant strong buys, okay, any given day, we have 350 strong buys. But if you had taken the market during that period and just taken the top 10 quant strong buys and you held on to them for 2 years, on average, from those 5 different pullbacks, your return would have been 117%. But what I really want to point out here too is not only if you invested in the quant strong buys during that period, would you have had a return of 117%. If you actually purchased the S&P 500, okay, and waited 2 years, your average return was almost 50%. So that's like a huge return that you get out of the S&P if you take advantage when the market has a 15% pullback. It's better if you go into stocks that have really strong fundamentals, okay, but you're still doing well even if you went into the S&P. And I think, we're almost really at that period, with the S&P now, we're probably down about 12% from its 52-week high. We're getting close to that 15% pullback. So these are the type of times where you actually want to start to look at the stocks that have good fundamentals. And that's going to lead me to the barbell approach that we're going with. So the tariffs are definitely a big structural problem. This is not a one-off event. It's not like a Silicon Valley Bank. And it's not even like a pandemic that you eventually know will be over at a certain period. People are very, very uncertain what's going to happen with the tariffs, what's going to happen with the tariff wars, what it means to companies in terms of their earnings, employing people. So there's a lot of uncertainty. And what we advise during periods like this is to use this barbell approach where we're looking at companies that pay dividends, but still companies that have very strong fundamentals, but still pay dividends, because that dividend and that yield will provide you with some downside protection. You're getting paid to wait. But we also don't want you to ignore the stocks that have the best potential returns going forward. So we're using this approach where we want you to continue to look for the companies on a data-driven approach and just ignore how much the stocks have come down. If they have strong quant grades for growth, for value, for profitability, that's all you really want to focus on, because some of these stocks are probably down 20, 30, maybe 40%, and has nothing to do with the fundamentals of the stocks. Okay. It has everything to do with the uncertainty environment and people selling stocks where they've made money to go to safe havens. So using this barbell approach will help you ensure that you have some limited protection right now in the current market, but it will also serve to help you in finding opportunities that can really pay off going forward. So as such, the Trump bump hits a slump, and we have 8 stocks for you. We have 4 reliable dividend stocks that can mitigate the risk in this volatile market, and 4 stocks that have strong growth that have pulled back significantly, and we're hoping to capture some upside potential here. So quickly, we're going to go into these stocks. This gives you a quick picture, though, that you can see what the quant strong buy ratings are, the valuation grades, the growth grades, the profitability grades, and you can see for the most part, these look pretty good. So I'm going to take you to our dividend paying stocks. And the first one up is going to be the Bank of New York. And before Francesca tells you a little bit about it, I'm actually going to take you to the Seeking Alpha platform, and we're going to go to BK. So we're now on the Seeking Alpha platform, and this is actually one of the stocks that we're recommending today that's up, which is a beverage company, but we're going to go to BK first, Bank of New York Mellon. You can see it's a strong buy. Over the last year, the stock is up 1%. And you can see year to date, the stock is actually up 5.8%. So it has significantly outperformed the S&P so far this year. Today, it's taking it on the nose, down about 5%, which is in line with the S&P. But if you look at the performance, especially the one-year performance, with the stock being up 41%, I'm going to take you right to the factor grades. So these factor grades give you an instant characterization of where the stock stands versus the rest of the sector. So you can see Bank of New York is in the financial sector. So what it's telling you is that the valuation is a little bit expensive compared to the sector. But frankly, for a stock that's up 41%, if you look at the valuation score now versus 6 months ago, it's roughly the same. So you've had a stock that has gone up 41%, but it has the same valuation framework. And what's really nice here is that the growth is actually a little bit stronger now than it was compared to where it was 6 months ago. But importantly, against these are sector relative. So you can see how it compares to the sector. You're one click away from looking at growth. So if you look at growth, you can see what the EBIT growth is, you can see what the EPS growth is, and you can see what the forward EPS growth is. So it's very intuitive. You can see that A- is because the company has a 24% forward growth rate versus the sector at 9.67. So it's trading at a 148% premium to the sector on its growth rate. So there's a lot of great metrics in here. If we go to profitability, you can see where it compares to the rest of the sector on net income margin, on capex to sales, or cash from operations, or cash per share, which is huge. They have $63 cash per share, hence the A+ grade, versus the rest of the financial sector at $6.87. So I just wanted to show you, if you're on the platform or if you're not a member, how quickly you can find out how these companies compare to other companies. And of course, you could just click on where it is in the industry or sector, and it will show you our ranking on every single bank or any comparable within its industry. I'm going to take us back to the presentation, and Francesca, I'm going to hand it over to you so you can tell us a little bit more.
Steve. And just as a quick note, all 8 of these stocks I'm about to dive into are in the article that was published under Steve's profile this morning. So he took you through the system. Feel free to poke around and look at these in a bit further detail through the article and Seeking Alpha's Quant platform. So BNY is a $60.2 billion company. Right now, it's ranked 29 in terms of all financials, but out of the custody bank industry specifically, it's number 2. And just a couple highlights from the Quant metrics that really stood out to us when we're making these assessments as to which stocks to recommend. There's a forward dividend yield of 2.2%, forward EPS gap growth of 24%, which is a 142.5 difference from the sector median, underlining strong growth. There's also really high dividend safety and consistency grades. The Quant dividend grades are a great measure of that category, and it goes into a little further detail on the dividends than just the regular Quant factor grades. So definitely recommend checking those out on the platform. And another great thing is that the profitability grade has improved from an F to a C+ just over the past 3 months. So similar to how Steve showed you the improvement with the valuation grade, we're seeing the same improvements in profitability while the share price remains relatively the same.
And as you said, good yield there, 2.2% yield, which is significantly higher than the S&P 500. Our beverage company?
Yes. Next up, we have Compañía Cervecerías. It is a beverage company out of Chile at 2.8 billion. It's a little bit smaller, consumer staples, and specifically in the brewing industry, but they do make soft drinks, bottled water. They're pretty diversified across the whole beverage sphere. Currently, it's ranked number 4 out of all consumer staple stocks by our Quant system, but it's number 1 out of its industry. And because this is a foreign stock, we don't have the forward dividend yield, but we do have the trailing, which is 2.97%. And it's up 33.7 year to date. Something to note about this stock in particular, this actually made another top 10 list of ours when we're talking about foreign stocks that investors are rotating into because of, all the turmoil that's been going on in the markets the past few months. So if you want to hear about other international stocks, I think I saw somebody ask a question in the comments already about whether we recommend going into foreign stocks. there's a much more comprehensive list under Steve's profile in an article published last week. And another highlight, 8% forward return on equity growth, which is a 12,093% difference. Very impressive. And we have a trailing PEG, that's price to earnings growth ratio, a very favored metric of ours because it gives you a really good glimpse into valuation on a deeper level than just maybe the PE. And that comes at a 66% discount to the sector median. So definitely a good price for the performance.
And something else I'll highlight on this, if you look at the card on the right-hand side in the quant rating history, you'll see that our quant system, I'm going to say it's somewhere around the November, December timeframe. It went from a hold to a strong buy. And you can see it really nailed it almost at the bottom there, going to that buy, because it has climbed significantly from that price to where it is today. So quant system really did a great job on selecting that stock. Our next stock, Alexander?
Definitely. I just saw a question pop up on how to find Steve's profile. So if you just type in Steven Cress into the main search bar on the Seeking Alpha website, you can click on his profile, and then there's a section that says analysis, and you can find every single article that he's ever written in order. So if you're just getting started on the quant system, that is a really good place to begin. So here we have a REIT. It's called Alexander and Baldwin. It's 1.25 billion. It's specifically considered a diversified REIT. So if you look into our REIT coverage, we usually like to have, a range of different types of REITs, but this one was the biggest standout to us when it comes to the stocks that are performing well in the so-called Trump slump. So it has a forward dividend yield of 5.14. That's really good. Obviously, that's why REITs are a great option for diversifying in a down market. This one's interesting because it's based in Honolulu. So it actually covers all types of different developments across the island, and not only just tourism, which is its biggest industry, but other industries as well. So it's very diversified. And it has a 77% forward FFO payout ratio, a 5-year compound annual growth rate of 5.3%, and forward AFFO growth rate of 7.7%, which is a 182% premium to the 2.75 sector median. Now, for sake of time, I'm not going over, every single metric and its difference from the sector median, but highly recommend checking out the quant system for yourself. It's going to give you tons and tons of data on valuation, growth, profitability, momentum, and revision, so you can explore that for yourself. Next up, we have another REIT. This is called Care Trust, and it's specifically focused on the healthcare sector. So it's a 1.25 billion. There's a forward dividend yield of 4.7%. So again, very juicy dividend yield there. This is more focused than the previous REIT. It is just skilled nursing facilities and senior housing properties, which are a really lucrative business right now. If you look at some of the quant metrics, we have FFO growth of 10%, which is a 271% premium to the sector median in terms of valuation. There's also a forward PE of 19.71, which represents a 42% discount to the sector median, even given its above average momentum and great performance that we're seeing. So highly recommend this one as well.
All right, now, Francesca, onto our growth stocks. So as we mentioned, it's a barbell approach. The stocks that we just went over, those 4 stocks, offered really nice dividend yields. Again, that yield affords you a little bit of cushion as the market sell off. You're getting paid to wait. But our approach, again, is a barbell approach. We don't want you to miss out on stocks that have come off sharply, that have great fundamentals. So Francesca is going to tell you about a few of those.
Exactly. It's all about growth at a reasonable price. So the first one we have on our growth list is AppLovin. Right now, its market cap is 92.6 billion, at least when this slide was made this morning. Of course, there's a lot of action with this particular stock, so that has been oscillating a lot. It's technically in the IT sector and the application software industry. It is a platform that helps digital advertisers reach their audiences with AI and all types of other technologies. So some of the highlights, we see revenue growth of 43%, EBIT growth year over year of 189% versus the 10% sector median, and levered FCF growth of 61% versus the 15% sector median. So there's a ton of great growth, a ton of great profitability. Momentum speaks for itself, and the valuation right now compared to all of those A-level characteristics is a great price. Now, this one has been a bit controversial because there have been some short reports that have come out on it, but I'll let Steve jump in quickly with his take.
Yeah, a lot of times when you have companies that have done really, really well, there'll be a couple firms that are names that you've never even heard of. In this case, it's like Muddy Waters, or it could be like Fuzzy Bear, and they tend to really collude with hedge funds. They issue reports that have negative information. Sometimes it's a lot of false information. Sometimes it's a lot of information taken out of context. The point that I want to highlight here is we look at the top tier firms for our forward growth numbers, and our model basically looks at historical numbers and forward numbers. The forward numbers are taken from Wall Street Consensus, and Wall Street Consensus on the stock has 19 analysts in the last 90 days that have taken their earnings revisions up, and only one professional analyst has taken it down. So we often get questions about these short reports, and we tell people we tend to go with a professional analyst who really know these companies. So we're not putting much in terms of our weight, or really nothing in terms of weight towards what Muddy Waters was saying in their short report. But again, there's so many of these companies that try to collude with hedge funds, and they say right in the reports that they have positions in these companies where they're short. So we try not to pay too much attention. We think AppLovin has some excellent fundamentals. And in fact, they were one of the companies that just recently announced that they wanted to be a buyer of TikTok. So on that announcement, the stock itself, AppLovin, was up about 10%. So very interesting.
Hey,
Take us
Steve,
to our next. Yeah,
Steve, 1 second. Actually, we got to address this real fast because we talk about
sure.
transparency all the time. So if you don't mind, can we go to our platform real quick?
Absolutely.
So app actually flipped to a hold today, and I was hoping you could take a quick second to show the change of the valuation of the factor grade and
All
why
right, let's
the
do it.
system has worked like that. So if you want to go into the quant history, maybe just walk people through what happened real fast.
All right, so we're in our platform, and I did this a little bit too quickly. So we put in APP, brings AppLovin up right away. And the beauty of our platform is you not only have the quant metrics on the right side and the ranking of where it is in the industry, and as Daniel highlighted, it actually moved to a hold. And it had been a strong buy yesterday. And we could tell you right now, the reason why it's gone to hold is the valuation grade actually dropped to a D minus. So one of our sort of circuit breakers with our system is if a valuation grade does go to a D minus, it will default to a hold. But I will highlight, this has almost straight A in terms of a report card for growth, profitability, momentum, and revisions. It was that valuation grade that took it down. In terms of transparency, which Daniel's highlighting, you can click on a ratings tab that we have, and this will show you for every single stock that we cover every single day what the directional recommendation is, what the quant score is, and what the valuation grades are. So you can see here, this was holding in the strong buy camp. There's been a lot of volatility with it recently, but you can see on the valuation grade, it had been D, 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 and then it flipped to D minus. Now, chances are with the stock price coming down as much as it has today, 9.78%, this could actually flip back from a D minus to D, which will take it back to strong buy. It's important to keep in mind, okay, this is a data-driven process. It operates on numbers. So when numbers move, there's a certain threshold that will occur where stocks will flip for valuation, growth, profitability. That's kind of the beauty of the system. It's not emotional. It's based on the data. But if you follow the data, you have to keep in mind stocks trade every single day. Valuation levels change every day. Growth levels change every day. So anything that has a ratio, that changes multiple times a day. So the quant system takes that into account. It's a real-time system. So the benefit is when you're making an investment decision, you're making that investment decision on real-time knowledge, as opposed to an article that could be written, by Morgan Stanley or Goldman Sachs that could be 4 weeks old or 8 weeks old. Nobody wants to make an investment decision based on information from a research report that was written 2 months ago. And that's the benefit of our quant system. But sometimes, since it follows every single trade, which comes through to every ratio, you will have fluctuations like that. And most importantly, I say a hold is a hold. A hold does not mean sell. Okay. We have sells and strong sells. That's when you sell a stock. A hold means that it's likely to perform in line with the industry. So you hold on to the position. I'm going to take us back to our platform. And
Thanks for clarifying that, Steve. I
Yeah.
just feel like we had to address that real quick for everybody. Now to hand it back to Francesca about EAT.
Thanks, guys. Yeah, it is crazy how these markets can shift on a dime. And just in the period of less than 12 hours, we're going from strong buy to hold. And I think that's a great lesson in terms of when you're reading our content as well. Sometimes we'll put out these articles and then an hour later, boom, the quant rating can shift. So always check things out on the system for yourself. But it is great that it's measuring everything in real time. So next up is a crowd favorite of the quant team, Brinker International. That is the restaurant company behind Chili's, probably their most famous. They also own a chain called Maggiano's Little Italy. It has market cap of 6.6 billion, consumer discretionary in the restaurant industry, as I said. And it's currently ranked #1 of all restaurants and #4 of all consumer discretionary. So very impressive rankings there. It makes sense considering that the shares have rallied 182% over the past year, which is impressive considering, what the markets have been through just in 2025. So they had great performance in Q4, 26% boost in annual revenues, and they nearly tripled their profitability. That's due to a lot of things. They rebranded themselves. They've put out a lot of emphasis on social media. If you've ever heard of the Chili's Triple Dipper, that's viral on TikTok. They're doing incredible things when it comes to getting their name out there. And also, it's very affordable. They actually, lowered the cost of their food in Q2 despite increasing inflation. So it's really a crowd favorite with customers and investors. And looking a little deeper into the quant metrics, price to earnings growth, like we said, that's a favorite valuation of ours. It's 0.5, which represents a 64% discount to the sector. So you're getting a lot of bang for your buck here. They have long-term EPS growth of 37.6%. Which comes in at a 233% difference to the sector. So C- valuation, as Steve has explained, those shift a lot, but in the grand scheme of things, a C- can still represent a really good discount, especially when you're looking at straight A pluses across all of our other quant categories.
especially with the PEG ratio that comes under that valuation, sometimes you'll have the conventional metrics like PE will be really expensive. But I love the PEG metric, which is it combines the PE with the growth rate, and it gives you a much greater sense of reality when you combine growth with PE. And often in companies where the overall value grade could be a D or D minus, sometimes that PEG ratio will be an A minus, A plus. Something to highlight here too, not only is Brinker a favorite with the quant team, in the last 90 days, you have had 20 analysts revise their estimates up and 0 have revised it down.
Yeah, that's
Francesca,
pretty
nice
rare these
stock.
days.
Yeah.
Thank you. So next up, we have TG Therapeutics. This is a biotech company in the healthcare sector, and they're most known for their drugs for B-cell medicated diseases, including multiple sclerosis. So they're a leader in that very important field. Looking at the quant metrics, forward EPS gap growth of 179% comes at a 1,169% difference to the sector. So really impressive growth compared to everywhere else in the healthcare sector. And with 5 upward EPS revisions compared to 1 negative, seems like Wall Street is relatively aligned with our strong buy assessment. And if you just take a look at the factor grades, everything's in the green. So definitely take a look at the quant system and poke through those numbers a little bit more, but really impressive metrics across the board.
Yeah, and you can see actually the valuation, it has improved to B minus from where it was 6 months ago at a D minus. and the growth is still A+. So that really makes it quite attractive.
All right,
Lifetime Group.
Oh, thank you. All right, so last but not least, we have Lifetime Group. If you're familiar with the Lifetime Fitness gyms, we see them around here in New York. They have a market capitalization of 6.6 billion. It's technically in the leisure facilities industry as categorized in our Quant system, and it's ranked #1 out of that industry and #6 out of all consumer discretionary sectors. So just like Brinker International, it is a leader in that category. And it's one of the categories that has been doing exceedingly well as investors are rotating into more defensive, non-cyclical stocks, which can be, utilities, healthcare, consumer discretionary. So it is a luxury fitness chain with 175 clubs across the US and 1.5 million members. We've seen those numbers really improve since COVID. Of course, a lot of these companies had to shutter gyms during the pandemic, and it's been a long road to restoring profitability. And Lifetime has been able to pull that off in part because they transformed their real estate strategy. So instead of buying properties themselves and shelling out to build these luxury gyms, they're working with existing landlords, and they figured out a way to kind of make the whole thing way more cost efficient. And looking at the quant metrics, we have forward EPS gap growth of 59%, which is a 624% difference to the sector median, as well as forward EBITDA growth of 18%, which is a 283% difference. And Steve just explained why he loves PEG. We all love PEG here on the quant team, and it has a trailing PEG of 0.41, which represents more than a 42% discount from the sector. And if you look at the valuation, you can see it has improved a little bit over the past 6 months from a D- to a D+.
And Francesca, I can tell you, as a member of Lifetime Group, I am incredibly impressed with their facilities. They
Nice.
do
Maybe
a
I should join.
fantastic job there. And I got to say, if people have to tighten their belt and times get tough, I will cut out a couple of restaurants before I cut out my fitness facility. So I think other people probably feel the same way. All right, I think that brings us to Q&A. So Daniel, I'm going to hand it over to you for the questions because I know we
I was
have
gonna
had a
say,
ton of
Steve,
questions come
we're
through.
we're running out of time here. I'd love to get to some of the questions here in the chat. So if you don't
Yeah,
mind doing that, we can
of
pause on
course.
these for another time. But one of the questions that came to light was recommending certain stocks and sectors that are typically don't do well in market environments during a pullback, right? You think about consumer discretionary, it comes top of mind. But you're always kind of finding these stocks that are strong buys within that sector. So I think somebody's just kind of wondering, like, how is it that the quant system can still recommend these stocks and sectors that are usually hit the hardest?
Yeah, so really what you have to do is not pay attention to the sector rotation. What we want to do is pay attention to companies that have really strong fundamentals. And often the companies that have strong fundamentals can be technology companies, that can be industrial companies or consumer discretionary companies. So the fact that the stocks have been sold off has more to do with like a rotation to safe havens than some of the fundamentals with these companies. So what we want to do is identify companies that have incredibly strong growth rates and good valuation frameworks. So a perfect example is I actually want to take you to a slide that I have from AlphaPix here. So AlphaPix is a separate service that we run. Trying to find stocks on your own could be difficult in good times, and in certain times like this, it could be even harder. But what I want to point out with AlphaPix, we happen to have a lot of companies that are IT stocks and consumer discretionary stocks. So if you look at the growth metrics for the AlphaPix portfolio, the revenue growth is 13.8% compared to the S&P, which has a revenue growth of 5.4%. The EPS growth for AlphaPix is 36% for EPS growth versus the S&P at 13%. And yet the PE multiple is only 18 times versus the S&P at 23 times. So you're getting a case here where you almost have a earnings growth rate that's 3 times greater than this S&P, but yet it's a cheaper valuation. So that's exactly what we want to do. We want to identify the companies that have strong growth rates and good valuation frameworks, because over time, fear fades and the market will return to fundamentals. So that's why, especially in periods like this, you could use this uncertainty as your best friend. And if you identify these stocks now, when the fear settles down and the market does return to fundamentals, you will definitely be rewarded by it.
Right, Lee said. All right, I'm gonna squeeze one more in here actually, because as I mentioned, we're gonna wrap up because we're past 5 o'clock here. But when it comes to us coming on these webinars, I saw this question, it comes up all the time. We're always recommending stocks to pick, and we're always saying, well, okay, it's the strong buy and it's the GARP system. Maybe just take a second to remind people what the GARP system is, because I think people are naturally thinking about, well, if you're saying buy this stock now, then the market must be bottoming. Right. I think that's the natural thought people have. So when we come here and we say, here's a list of 8 stocks today, maybe just give them the compelling explanation of the growth at a reasonable price.
Right, exactly. So, and we're not saying that the market has bottomed here yet, but what we're saying is the pullback has been significant enough that you probably want to start paying attention to these companies that have incredible fundamentals. So when we look at GARP, growth at a reasonable price, we're looking for companies that have strong growth rates at a reasonable valuation. And I think, really to like highlight this. So a lot of people are moving into consumer staple stocks right now. So look at the EPS, the average EPS growth rate for Alpha Picks is 36%. Okay. And I highlighted compared to the S&P, it's 13%. But this is a 36% EPS growth rate. So I'm going to take us to our platform so you can see what the growth rate is for a sector that people are going to, which is consumer staples. So here we have 36% for Alpha Picks. So I'm going to go to Pepsi, which is actually a stock that we do have in Alpha Picks. But what I want to highlight is I'm going to click on growth. And we're going to look at the EPS growth rate. So for the consumer staples sector, the growth rate is 8%. Okay. So as an investor, wouldn't you want to be investing in companies that have a growth rate that's 36% as opposed to a growth rate that's only 8%? And in the same token, the multiple for the Alpha Picks portfolio is 18 times. If we go to the multiple for the consumer staples sector, okay, it's actually on a trailing basis, it's 21 times. On a forward basis, it's 19 times. So the average PE for the Alpha Picks portfolio is 18 times. It's actually at a discount to the consumer staples sector. So this is the sector that people are flying to. And the reason why they're flying to it is consumer staple companies tend to have very stable earnings no matter what the environment is. People are still going to need to drink. They're still going to have their beverages. They're still going to have to buy certain foods. So that's why they tend to go to that. Or they'll go to the utility sector because they need to keep the lights on in the house. Okay. But you're looking at growth rates that are much, much lower and valuations at this point, which are actually more expensive than stocks that we consider attractive. So again, in Alpha Picks, we have about 38 stocks in the portfolio. And of the 38 stocks, the average EPS growth is 36%. The average PE is 18 times. That is actually at a discount to consumer staples with a growth rate that's triple, more than triple than the consumer staples sector. So Daya, hopefully that answers your question. Daya, I think, maybe we could take a couple more questions. It's a pretty hectic day. I know we normally like to keep these to an hour, but some people might want to hang on a little bit longer. So, ask away with a couple more questions.
Well, then let's go back to the platform real quick. I got
Sure.
one for you. Came up. So a company like Nike got demolished today off of the tariff news. And I think this is a compelling case that you can maybe walk us through not only the quant system here, but also focus on the dividend grades and kind of give us a look into what you're seeing here.
Okay. Well, from a quant system, it does have a hold on the stock, but not all holds are created equal. So one of the things I can tell you that doesn't look really attractive about Nike is you do have that valuation grade at a D, but what is not great is the growth grade is an F. So it's one click away. You can see these underlying metrics. The reason why Nike has an F for growth is the year-over-year growth rate is actually negative 7.3%, and the forward growth rate is negative 3%. So the top line growth for this company is negative. If we look at some of the bottom line EBITDA numbers, the EBITDA growth is negative 15% year over year, and forward it is negative 13%. So growth does not look good for this company. And the forward growth rate is negative. So Nike is really not an attractive stock. So when you throw the tariffs on top of it, this was the picture of it pre-tariffs. Okay. Now you throw the tariffs on top of it. Growth just does not look good for a company like Nike. And this is kind of what the quant system is telling you. So we like stocks that look good on a GARP basis, growth at a reasonable price. Nike would not fit that because the growth is in the negative domain and the valuation is expensive. So this would not make a quant strong buy.
Thanks for that. So there was a question about the slide you shared earlier about the median time of a market pullback, and coming down to August 9th is the date that they're saying, give or take. So they're asking, why not wait until August to invest in stocks? Why start buying stocks now?
Okay, so one of the examples that I showed is we went back to the beginning of 2010. There have been 5 market pullbacks of 15% at that point. So when the market is down 15%, if you held it for 2 years, we showed you on average, if you took advantage of the top 10 quant stocks, it was up 117%. The S&P was up 50%. So when it's down 15%, that's actually a good point to start, dipping your toes in the water and start looking for some of these stocks. Particularly if the market is down 15%, the stocks that are probably the quant strong buys are down even more because a lot of them started coming off in early January and February pretty significantly. You may recall I said the quant is like a Richter scale. When we have stocks that we've identified as strong buys that are really attractive and that have had good run-ups on momentum, they'll sometimes be the first things that get sold. People will take profits where they've made money as they look to put it into cash or to consumer staples or gold. So chances are a number of the stocks that we like probably have already sold off more than the market. So using that level for the market as a benchmark at down 15% is usually a fairly good time to start putting your toes back in the water. But certainly I'd say, be patient. If you have powder on the sideline, just use a little bit of it. I would especially say if you have stocks that are speculative companies where there are no earnings growth, where the earnings could be negative, you might want to move out of some of those speculative investments, put the money into stocks that have dividends or stocks that have really good fundamentals. This is definitely not a good period for speculative investments. And you probably have noticed a lot of the Russell stocks, the small cap stocks, have sold off considerably from its 52-week high. And that's because there's so much uncertainty with inflation. With tariffs, it brings inflation. There's always that scarcity value that interest rates are going to have to move up if you have inflation. Small caps don't do well during that period. So if you have small cap stocks that have limited profitability, you may want to choose to sell some of those stocks to have some cash to put into the quality stocks.
All right. And one last question here. People are asking the quant system, how do they know when to sell the stock, right? Because these are all strong buys. When do they know to sell?
Well, when the quant grade goes to sell or strong sell, that's how you know. So a little bit different from what I said early on, where the quant system could often be like a Richter scale. It gives me that sign, like I start to see volatilities in our strong buy stocks that have performed extraordinarily well. They start selling off. And when they sell off in size, and not size like just being one company, but like a big breadth of the stocks start to sell off, it notifies me that there's a rotation that's starting to occur. That doesn't mean sell those stocks. That means the fundamentals are actually getting more and more attractive as those stocks are getting cheaper. But for a stock that you buy as a quant, when you really want to know to sell it, it's when the directional recommendation changes to sell or strong sell.
Perfect. And I know that's a strategy you use within the Alpha Picks portfolio, right? So investing you just want to take a second and just kind of tell people about that.
Yeah, so we will sort of end on that. I mentioned the Alpha Picks portfolio. Investing, it often requires a lot of time. You could be a sophisticated or an engaged investor, or you could be a beginner. Time is often limited. So what we do with Alpha Picks is every month we take our top 2 quant recommendations and we bring it forward on the trading day closest to the 1st of the month and the 15th of the month. We send out an article on some of our top quant stocks. And we started this about a little more than 2.5 years ago. And you can see the performance has been exceptional. Alpha Picks is up 129% versus the S&P up 48%. And I could say pretty consistently since inception, whether you look at a 1 month time frame or a 1 year time frame or 6 months, it's outperformed. I will say in the last month that has changed. And since February, a lot of our alpha pick stocks have gotten completely clobbered. But again, it doesn't have anything to do with the results. So I've grayed out most of the names here, but we just finished up our recent earnings period, and we saw that 87% of the alpha pick stocks beat earnings estimates that were out there from Wall Street analysts versus the S&P 500, where only 75% of the stock had beaten analyst expectations. So it's a really positive sign. And what you can see here is a list of all the companies with the EPS surprise. So almost every one of them, okay, beat analyst expectations in the most recent quarter, and pretty much the same for the top line. Really, some of them, two of them were just off minimally. You're talking about companies that make billions of dollars. So to be like 9 million off of like 3.7 billion is really like a non-event. So for the most part, these companies really did great off of the last earnings period, beating both top and bottom line expectations. But many of these stocks have gotten crushed since February, bringing down the returns of alpha picks. So again, uncertainty can be your best friend. You want to take advantage. You want to invest in companies that have strong growth rates, top line and bottom line. And that's what we bring forward with alpha picks. But markets come down. There's nothing we can do about it. But what you can do is take advantage of the opportunity that it presents. And we've shown many examples in this presentation going back to 1929 for the duration that markets come off, how much they come off, but how much they appreciate in the period following when they've had that decline. And that's really what it comes down to here today is don't let fear get the best of you. Be a disciplined investor, okay? And look to make structural moves at this point where you find stocks with good fundamentals. Because the more the market comes off here, the greater your return is going to be. And it doesn't take that long. Okay. Even during the Great Depression, when the market had its biggest move down 89% in a 2-year period, had you invested 1 year later, you would have been up over 100%. And we found the same thing during the pandemic. We found the same thing during the financial crisis. And we're going to find it into the future as well.
Steve, Francesca, we can't thank you enough. Obviously, as I mentioned at the top, probably the most important webinar we have ever done with the markets that we're in. I mean, this has been incredible. Thank you so much for taking the time to put all this data together, walk us through the history, present these stocks, walk us through the metrics, walk us through the platform. There's been a lot of positive comments coming into the chat. And anybody watching the replay, I hope you learned something as well. Highly encourage you to go follow Steven's profile here on Seeking Alpha to read all of his analysis. Check out Alpha Picks, and we'll see you here soon in the next video.
Thank you so much, everybody.
Thanks, everyone.